Hello everyone, I am Shaza Farwadi, investment analyst at Azad Asset Management. Let's talk about what happened in the economy and overall market in the third quarter of 2023. But first, here's a little bit about me. As I said, I am an investment analyst at Azad Asset Management. I have 7+ years in financial industry experience, and I am a member of Azad's investment committee. I have a master in finance, and I hold the securities license Series 65. According to the Commerce Department, gross domestic product or GDP, which is a measure of all goods and services produced in the US, rose at a 4.9% annualized pace in the third quarter. That is ahead of 4.7% estimate and up from an unrevised 2.1% pace in the second quarter. Looking at the bond and stock market, we can see from the table that all were in red in the third quarter, except for the high yield bond, the US high yield bond. The main reason for the decline in both bonds and stock was higher for longer interest rate. Fixed income securities that mature in less than 3 years have performed well this year as their yield climbed above 5% and they have less duration risk than intermediate term fixed income securities. For halal investors, the Azad Wise Capital Fund is a good halal alternative to these short-term bonds. If interest rates are higher for longer, that means business refinancing will become very expensive. Also, inflation, especially higher crude oil prices, will make raw material, shipping, and overall costs more expensive for businesses. All this may cause companies to try to cut expenses from other places and could eventually lead to laying off workers. Additionally, if we look at the personal saving rate and the disposable personal income, we can find that savings are going down and disposable income are flattening, just like you see here in the chart. This is why most economists, including our portfolio managers, believe that we could see a shallow recession, possibly in the first half of 2024. However, do not fear a recession. It is normal stage in the economic cycle. In fact, recession happen on average every 6.5 years. From this chart, you can see that the S&P 500 performed positively 45% of the time during the 12 months before a recession, 6 months before a recession, and during a recession. Additionally, on average, the worst was negative 3% during the 12 months before a recession. Now let's turn to the stock market. We can see that in 2023, the market started strong in the first and second quarter of 2023, but did not last into the third quarter. As of September 2023, the S&P 500 fell 3.6% and is now just over 13% for the year. US mid-cap and small-cap stocks, as well as foreign equities, have positive return for the year, but have underperformed the US large-cap stocks in 2023, as we will see just now. Large-cap stocks, especially growth stocks, have dominated the market, returning 24.98% year-to-date, declining 3.13% in the third quarter. On the other hand, large-cap value stocks and dividend stock are up only 1.79% and 0.1% respectively year-to-date, falling 3.16% and 5.44% respectively in the third quarter. Mid-cap growth and small-cap growth stocks are up 9.88% and 5.24% respectively, compared to 0.54% and 0.53% for mid-cap value stocks and small-cap value stocks. But we do caution investors not to conclude from this short-term performance that growth outperformed value. This is not always the case. Diversification across different asset classes is very important. On the global side, developed international stocks and emerging market stock returned 5.34% and 1.82% year-to-date respectively, and declined 3.77% and 2.62% respectively in the third quarter. Real estate investment trust stocks were down 2.05% year to date and 7.4% in the third quarter. On the sector side, almost all sectors performed negatively in the third quarter except for energy and communication services. Generally, when investors expect a recession or a slowdown in the market, they invest in defensive stocks. However, up until the third quarter, these sectors were the worst performers. As as one of our Zad Ethical Fund portfolio managers recently said, the best defense is a good offense, and the good offense is buying the right company with the right capital structure with a defensible not only products or services but also capitalization structure, how they are put together to finance their own operation, how much that they have, and so forth. So what does all this mean for investors? Despite the many risks to economic growth, we believe that equity valuations are more reasonable than they were just a few months ago. Fixed income investors, including those investing in the Wise Capital Fund, are seeing some attractive yields. Many of our portfolio managers see this market as ripe for active portfolio managers. It is also not all gloom in the economy. Core inflation is much lower at this point in 2023 than it was in 2022, and the labor market continues to be strong. But like I said, there are risks in the economy, including a possible recession on the horizon, albeit one that is expected to be short and shallow by most economists. But while it can be easy to get caught up by the latest headlines, most often the prudent course of action is to stick to your long-term investing plan. Remember that it is time in the market rather than timing the market that will get you closer to achieving your financial objectives. Recession and bear market can both feel painful in the short term, but they are normal and even healthy for the economy and stock market. We recommend using risk control strategies like dollar cost averaging. This is investing a set amount of money, such as $1,000 every month, regardless of what's happening in the market. Most of us do this without thinking within our 401k accounts. Instead of fearing down markets, think of them as opportunities to invest at lower prices. Also, consider rebalancing your portfolio at regular intervals and using losses to offset capital gains. It is more important now than ever to maintain a diversified portfolio. Different investments may go up and down at different times. Spreading your money over a variety of investment types can help reduce volatility in your portfolio. And of course, keep in touch with your financial advisor. Make sure you're reviewing your financial plan on a regular basis to make sure your portfolio does not have more risk than you can handle or less risk than you can afford to meet your long-term financial goals. Your advisor can help you avoid making decisions that could jeopardize your goals, which often remain unchanged during the market declines.